Hello my students, welcome to JMC Learning Business Studies and Accounting Session 1. Today we are going to discuss the fourth lesson of your textbook, Introduction to Accounting. Okay, before everything, now let's see what is this term accounting means. By now you have covered this lesson. So, if I ask from you what is accounting, you may give me many definitions in various angles. Now, let's see what is this accounting. Accounting, as it seems, it is not a single term or a single concept. Accounting is a process. Accounting is a process. A process means that has an input, process and an output. So, accounting process gives an outcome. That outcome we are providing. The outcome of this accounting process, we are providing it. Accounting is a process of providing. It provides. Providing what? At the end of this process, the output is accounting information. So, the thing that we are providing is accounting information. But in here, we are using another term for that information. We call that information economic information. What is it? Economic information. Economic information. Economic information are the transactions and events that has a monetary nature to it, that can be measured by money. So, in this is a process of providing, we are giving economic information, that means transactions and events that can be measured in monetary values. To whom? To provide something, we have to have another party. Now, we are the business who are providing information. To whom we are providing? To stakeholders. Stakeholders. Who are the stakeholders? The stakeholders are the people who are having an interest or a liking towards our business. Basically, we identify three types of stakeholders. Stakeholders we identify of three types. Number one, owners. Owners. Owners are the people who invest capital to start a business. Owners are the people who invest capital to start a business. And not only starting the business, they expect a substantial return for their investment. They don't stop by investing cash or another asset. They are expecting something, expecting a substantial return. That return should be sufficient for their investment. So, owners need this information. What information? This economic information to know whether we are earning a profit or how are we doing the business, how is our performance. To know those facts, owners require information. And another party, managers. Managers are the people who controls the business and control business resources on behalf of these owners. On behalf of these owners, managers doing owner's job on behalf of them, because sometimes even a person start a business, he should not have that certain or particular knowledge about some business fields, or he doesn't know how to do this recording of transactions, how to obey legal requirements regarding a business organization. So, he does not have all the knowledge required to continue a business. Therefore, in that case, he takes managers to do the job he has to do on behalf of him, to control business resources and to control business activities on behalf of the owners. And the third party we are providing economic information is creditors. Creditors we can known as lenders. Creditors are the parties who provide us loans or other facilities that are on a credit basis. That means we are obtaining a loan or stocks or like that, anything, any asset, and we promise and we agree to pay them on a later date. So, we are liable to them. Therefore, they are expecting this economic information to know whether we can pay their loan back, to know whether we can recover their loan. So, now I explained you why these parties are interested in our business, and I didn't tell you why these parties are expecting our economic information, or why are we providing them with our information. We are providing these parties our information because they have to take decisions. These parties, as well as there are more parties like employees, government, other legal organizations, there are so many stakeholders for a business. But mainly these three types of people or parties are required to know this information because they have to make decisions about our business. Now, if we take owners, they have to decide whether they get a substantial return, first of all. Then they have to decide whether to invest further, or if they have already invested, whether to sell it, transfer it to another party. Managers need this information to make their decisions about how the business activities are going on, how the assets are controlled, how the liabilities are taken place. Are their decisions working? To know the effectiveness of their decision making, they have to know this economic information. And the creditors, the decisions they make is whether we can repay that, or whether to allow us another credit period, or whether to give us discounts. For those decisions, they need this information. Therefore, if we got beginning, this is a process of providing what? Economic information to whom? Stakeholders. Why? To take decisions. To take decisions. Therefore, we can summarize a definition for the accounting as a process of providing economic information to stakeholders in order to take decisions. Now, let's focus on the note of your screen. There, I have this definition nice and clear. Please focus on your screen. There, I have mentioned accounting, the process of providing economic information of the business to the interested parties such as owners, managers and creditors. And please go through these objectives of accounting: providing financial information to stakeholders, fulfilling legal requirements, evaluating results of the business activities, control and manage economic activities. Those are the basic objectives of accounting. And next we have accounting process: identifying and measuring transactions and events, recording, classifying, summarizing, analyzing. And next, the output: communicating economic information via financial statements. Here, recording means copying down or extracting information from the source documents and recording in the relevant places. Classifying means we are classifying the information. For example, if we take sales, we are classifying sales into credit and cash. Summarizing means balancing of our accounts and preparing the required accounts. Analyzing means further interpreting and evaluating these accounting information. Next, I have given you transaction, the definition of a transaction: an incident with a monetary nature which results in changing business resources or capital. You have given an example: owner investing capital 100,000. Next, accounting entity: a certain person, organization, business or a country which becomes the base for accounting activities. When we are doing accounting for a person, we call that personal accounting, and business accounting, then if we are doing it for a country, we call it national accounting. Then I have given you the definition for financial statements. Financial statements are the output of this accounting process: a set of accounting documents providing information relevant to the financial position and performance of a certain entity. And please go through the next topic also: stakeholders and their information needs. The three of these stakeholders I explained here: owners, managers and creditors. And there is an additional one, the government. The government is basically focusing on about the tax payment, whether the taxes are paid in due time, and what are the decisions to be taken in future for the development of the businesses. Now my students, I hope you understood the previous part of our lesson, Introduction to Accounting. Now we are moving on to the second part of this lesson, Elements of Accounting. In accounting, just like in science, we have elements. Based on these elements, there are major information depends. Now, the first element we are going to discuss is assets. To identify a resource as an asset, you should satisfy 4 criteria. So, focus on your screen. There you can see what are these 4 criteria. Now, let us move on to the screen. Assets. In order to identify a resource as an asset, following criteria to be satisfied. First is a resource controlled by the business. Controlled by the business, that part is highlighted, you can see it. Controlling means that we have to take benefits, not the others. That does not mean we have to have the legal right over the asset. We can rent it, we can hire it. The only factor is we are the party who are controlling the asset. Okay. Next point, generated as a result of past transaction. Because we purchased it or acquired it in the past, that is why we are using it today. So, assets are generated as a result of a past transaction. Number 3, possibility of inflow of future economic benefits to the entity. We have to get benefits from these assets to our business. Monetary benefits, not just only benefits, economic benefits, that means monetary benefits. We have to get monetary benefits to the entity. That means we have to generate some sort of income or a cash flow to the entity. Number 4, value can be measured reliably. The value of the asset should be able to measured approximately or accurately, reliably. That means we have to have a figure, that means numbers, to show as the value of this asset. Therefore, my students, to be an asset, any resource or any item should satisfy these 4 criteria. Let's focus again to this criteria. A resource controlled by the business, generated as a result of past transaction, possibility of inflow of future economic benefits to the entity, and its value can be measured reliably. We focused on the screen and we learnt there are 4 criterion to identify an asset. But assets also can be divided into 2 parts again. Let's see. Assets can be divided into 2 parts again as current assets and non-current assets. Current assets and non-current assets. What are the current assets? Current assets are the assets, that means the resources which satisfy those 4 criterion we learnt earlier, but those assets are used or sold. Or converted into cash. Used, sold or converted to cash. Converted. To cash. We can use it in the business or sell it. Think we are purchasing furniture. If we want, we can use it as office furniture. Or else, if we are doing a furniture business, we can sell it. Or we can exchange it to a cash or cash equivalent. So that is why I said used in the business, to be sold or converted to cash. Any of these three items. But the condition here is these actions are to be taken within 12 months. Within how many months? 12 months. Within 12 months, that means within a year. Current assets are the assets that satisfy 4 criterion we learned, and also used, sold or converted to cash within 12 months. Understood? Next part is non-current. If this is current assets, now you can build a definition yourself for non-current assets. It is also the same. The assets that are used, sold or converted to cash, but not within 12 months. The only difference is after 12 months. After 12 months. These assets, businesses are intended to sell, use or convert into cash within an year, within 12 months. But non-current assets are expected or intended to use, sell or convert to cash after 12 months. They are using the asset in the business more than 12 months and sell it or convert to cash after 12 months. Now let's move on to your note. In the screen, you can see your note about this current and non-current assets. Let's check the note. Current assets. Assets which are expected to be used, sold or converted into cash within 12 months. Examples: cash. My dear students, cash, here there is nothing to convert. It is already converted to cash. So, we are moving on. Bank balance. The bank balance means the savings or the current account balance in the business name's bank account. That means the cash balance in the business bank account. Debtors. Debtors are the person or organization that owes money for the business. The definition is given under the explanation of current assets. And inventory. Inventory are the stocks of goods brought to used in the production, such as raw material. Next, non-current assets. Assets which are expected to be sold or converted into cash after 12 months or used in the business in 1 year. You have given some examples also: buildings, furniture, land. Please go through these notes, and if you want you can write it down and take that to your exams also. Now, we have already discussed about assets. Moving on, next element is liabilities. Liabilities. Liabilities also have some criterion to be satisfied. So, let's look at your screen. There I have listed those criteria. In order to identify a liability, following criteria to be satisfied. Present obligation. Obligation is a similar word to a liability. That means we have a bond, a liability, a responsibility to pay something to another party. That is why here we have mentioned present obligation. Next, generated as a result of past transactions. Just like the assets, the liability is also there because we obtained it, we owed it in the past. Possibility of outflow of resources at the time of settlement. When we are discussing about assets, there we saw inflow of economic benefits. But in here, we have mentioned outflow of economic resources. That means when we are settling, when we are getting rid of that liability, we have to give or outflow our cash or cash equivalents. That is why we are here showed you possibility of outflow of resources at the time of settlement. When we are paying back that liability, some of our business resources are moved out, outflowed to another party. Fourth point, value can be measured reliably, just like the previous one. The value can be measured with confirming and transparently and approximately or accurately. Now my students, to identify something, an item as a liability, it is compulsory to satisfy those criteria. All the four of those criterion are requested or required to be satisfied. Just like assets, we can divide liabilities also to two parts. Just like we divided assets, we can divide liabilities. Liabilities also two parts, same as that, current and non-current. The only difference is settlement time. Current liabilities are liabilities that should be settled within 12 months. Current liabilities are the liabilities, those should be settled within 12 months. This is very important. Within 12 months. This is very important. Okay. Now, next part is non-current. Just like the assets, the liabilities should be settled after 12 months. We have 12 months to settle this liability. It can be after 3 years, 2 years, 5 years, like that. Now, let's move on to your screen again. There I have a definition for non-current and current liabilities. Let's check it. Current liabilities. Liabilities which are expected to be settled within 12 months. Examples: creditors and accrued expenses. Creditor: the person or organization for that business owes money. We know that already. Next, accrued expenses. Expense that haven't been paid yet after consuming the good or the service. That means we have already consumed that. Think electricity. We are using electricity and we are getting a bill. But if we haven't paid the bill after consuming electricity, that means we have used it but not paid. That kind of expenses are called as accrued expenses. Next, non-current liabilities. Liabilities which are expected to be settled after 12 months. Examples: bank loans. Bank loans normally we settle after 2 years, 5 years, 10 years, maybe 20 years, like that. Now you know what are assets and liabilities. The third element of accounting equation or the accounting concept is equity. Equity. Equity is something that can be defined as the amount belongs to the owner. Now we know owners are investing capital to the business and he purchased assets and obtained liabilities. After everything, now he investing to the business. This is the business. Owner is investing. By this invested money or the assets, we purchase required things for the business. And also we obtain liabilities. When the invested capital is not enough. Here we purchase assets. Equity is the residue of the amounts after reducing liabilities from these existing assets. Because owner cannot take home what is not his. Simply, if something doesn't belong to his custody, he can't take it home. The assets he purchased using the invested money or the business money belongs to him. But the liabilities, just like bank loan, creditors, those things does not belong to him. Those are external liabilities, external responsibilities that we have to settle in someday. Therefore, these things doesn't belong to the owner. The things belong to the owner are the residues after deducting net value of liabilities deducted from assets. Simply, equity means equity. There is a keyword assets minus liability. After deducting liabilities from assets only, the owner belongs. Now, let's focus on your screen. Equity. The remaining value of owner's interest. Owner's interest means the things owned by the owner. Things belongs to the owner. After reducing all liabilities from assets of the company. Any business has assets. So, after reducing the external liabilities, the rest of the amount, the remaining value is called equity. Now we discussed what is equity. Let's see an example. Here we have assets 100,000 rupees, liabilities 30,000 rupees. I told you equity is the remaining amount of as liabilities reduced from assets. So, equity is the amount after liabilities reduced from assets. Like that. So, here we have assets of 100,000. It can be buildings, cash, anything. 100,000. We have to reduce liabilities because this 30,000 does not belongs to the business or the owner. We have to pay it in another day, in a future day. We have to pay it back. So, we have to reduce it from the things that owner belongs. So, we are reducing 30,000. Now, what is the amount remained for the owner? Rupees 70,000. This is the equity of this business. We have assets. From that amount of assets, we have to reduce or redeem from the amounts of liabilities that are the loans or the debts we have for external parties. Therefore, we have to get rid of this amount. We reduce it. Then the remaining part we call equity, the 70,000. I think this is clear for you. Now, let's move on to the next element of accounting. It is income. Income. Now, again, focus on your screen. There is a description about this income. Income. Increasing in equity as a result of increasing assets or decreasing liability other than investing capital by the owner. Examples, sales income. In here it says two options. Either it should increase assets or decrease liabilities. But at the end result should be increasing equity. No matter what happens, we can increase assets or decrease liabilities, but the thing is at the end equity should be increased. Now, in the given example, sales income, let's take it. Sales income means we are selling goods and we are receiving cash. Cash is an asset. Therefore, assets increasing. Increasing assets means what? We are increasing equity. Now we discussed 4 elements of accounting: assets, liabilities, equity and income. Let's move on to the next element, expenses. Let's see the definition of expenses. Please come to your screen and read it. Expenses: decreasing in equity as a result of decreasing assets or increasing liability other than drawings by the owner. My students, drawings means owner taking business assets, that means cash or inventory or any other asset, for his personal use. For his personal use. Now you have given an example, paying electricity expenses. Now we know what are the expenses. Let me explain. If assets decreasing or liabilities increasing, the opposite of the income, resulting to reducing equity. The example I have given you is paying electricity bill. When paying electricity bill, the cash, the asset is going outside the business, that means reducing. As a result, what will happen? The things owned by the owner, things remain to the owner, are also reducing. Now, I think you are having a good idea about expenses and all the other elements. Let's check. Let's revise the definitions or the criteria of these elements. Number 1, assets. To be an asset, the resources should have controlled by the business as a result of past transaction, and what are the other things? Yes, value can be measured reliably and possibility of inflow of future cash flows. Liabilities, present obligation generated as a result of past transaction, at the settlement outflow of resources, and value can be measured reliably. Equity, the remaining amount of owner's interest after reducing external liabilities from the business assets. Income, income is resulting increasing in equity as a result of increasing in assets or decreasing liability. Expenses, the opposite, decrease in equity as a result of decreasing assets or increasing liability. Now students, using these 2 elements, we can calculate business profit. Let me show you how to do that. Income are the things we received instead of or out of capital, minus expenses. When expenses are reduced from income of a business, there you get what? Profit of the business. As an example, let's say we have an income of rupees 100,000 and we have to bear expenses of the office or the organization like electricity, telephone bills, water bills, maintenance, like that. those expenses valued to 70,000. Now let's find the profit. Income minus expenses. Income is 100,000. Expenses 70,000. Profit is how much? 70,000 minus 100,000 rupees 30,000. This is a simple thing to remember because in grade level you are learning in a descriptive manner how to calculate business profit. So keep in your mind, if you are asked to make the profit of a business, the simplest way is deducting expenses from the income generated. Okay, now let's move on to the next lesson.